What's up, guys? Hope you're doing well. How you doing? Just want to give you a quick update about what's happening with the banking crisis, Deutsche Bank, Credit Suisse. But before we get started, I just want to explain a concept to you is banking capital. So banking capital, every bank has capital. Usually, capital consists of Tier 1 and Tier 2. Tier 1 is a bank retained earnings, revenue, common stocks, assets that they have invested, say, in treasury bonds, mortgage-backed security. Tier 2 is has subordinated debt, similar to what's happening with Credit Suisse and Deutsche Bank. The panic that's happening is because of bond investors investing in subordinated bonds. Yeah, so the bank typically issues these bonds to raise capital so they can pay back debt, lenders, depositors, clients, stuff like that. With this, that's what they raise capital. They issue these bonds, and then you have the bond investors. So yeah. But anyways, Deutsche Bank. Um, there's a big panic at Deutsche Bank, similar to how it started with Credit Suisse, with the subordinated debt. Reason why is a lot of these investors are wondering if Deutsche Bank they're not disclosing a lot of debt on their balance sheet, so they're wondering if their liabilities exceeds their assets, because if their liabilities exceed their assets, they don't have sufficient capital in case there's a bank run, say depositors want their money back, or they all say that a lender like a bank, another bank, some money, they can't pay it back, and so who gets screwed is these subordinated bond investors, because the subordinated bond got rules. One of them is this call option. So, a bank can redeem it early and repay investors, or they can, in case of a crisis, the bank shuts down, collapses. They don't have to pay back these bond investors, and that's why the subordinated debt has a really really high risky rate. Now, bond investors typically invest in these subordinated debt bonds because of the high yield, and there's a high yield because it's risky. So, but it's a nice way to for them to make quick money really fast. And so you have a lot of these investors, like corporations and big institutions, that want to raise quick cash. So they typically buy these bonds and earn high rates. Um, but the disadvantage is, in times of crisis, the bank um, um, is not obligated to pay the subordinated debt first. Has lesser priority than other debt. So that's why it's additional tier 2, additional tier 1. Now, additional tier 1 has the least priority to be paid off. Additional tier 2 has the higher priority than additional tier 1. So that's what's happening, and the fact the credit swap rate keeps going up from 143 basis points to 200 basis points. That actually made investors hella panic, and but most of it got to do to because of the money laundering the Deutsche Bank had over the years, a lot of shady information, but what clients they have, because over there in Europe, they don't have strict law as we have here in the U.S. Typically when depositing the money, they don't ask you where it's coming from, and all of these questions like we have here in the U.S. So a lot of people just have freedom depositing money, especially to what happened in Credit Suisse. Credit Suisse. That's why it's people go to Switzerland, and Credit Suisse accept anybody. They never ask, where'd you get the money from? Or you have cartels depositing money at Credit Suisse. You have crazy people in the world. The deposited money, probably stolen money or something at Credit Suisse, just because they don't ask questions where it's coming from. You know, unlike here in the U.S. So yeah, so a lot of shady information about Deutsche Bank too. So and that's having having the investors lose trust in the banking system, especially with Deutsche Bank, and because they don't want to end up in the same case scenario like Credit Suisse and end up losing all their investments in the subordinated debt. Um, Although Credit Suisse, Deutsche Bank announced that they would redeem these bonds just so they can regain confidence in their investors to show them that, oh, we do have the liquidity available. You don't have to worry about it. We're not gonna go through liquidity crunch like what happened in Credit Suisse. We have the available capital. We can give you back your money. You don't have to worry about it. We have available assets. But still, I mean, people think the speculation rumors that that they have say 60% of their assets stuck in these treasury bonds or governmental bonds, which is like I was telling you about earlier in my video, the capital tier one layer that has a bank's assets invested in treasury bonds and governmental bonds, safe bonds, but but has a long dated maturity probably, and so they can, if depositors want their money back right away, they won't be able to pull it out, and if they do pull it out, just because the interest rate has been jumping a lot, that would definitely affect the yield in the bond price. The yield is skyrocketing, the bond will be plummeting. They're inversely proportional. When you have a high yield on a bond, the bond price is gonna lose lots of value, especially if you're trying to sell it before maturity. And so that's why people are worried that they don't know how much assets that's stuck in the bonds. Typically banks get too greedy. They put 70% of their assets in these bonds just so they can earn interest over time. But that's what's happening now. Deutsche Bank is a bit different from Credit Suisse because they've been making a lot of revenue over the years and minimizing their losses just because they came up with a restructuring plan, laying off people, cutting costs. So that definitely helped them with the adding revenue, minimizing losses. Unlike Credit Suisse, they've lost tons of revenue over the years. Their losses increased. They had lots of exposures to Silicon Valley Bank, for example. Lots of their assets invested. Money that they lent to other banks lost value. Uh, couldn't get it back. Lots of increased losses at Credit Suisse. But investors are wondering if the Deutsche Bank had exposure to Silicon Valley Bank and Credit Suisse, and if it's related, and how much assets do they have invested in bonds, for example, because or do they have available reserves if say the majority of their assets are invested in treasury bonds, for example, um, and that's the problem with these banks. Their management is really poor and hella stupid when you invest all your money in one area, um, not thinking that, oh, what if there's a bank run and people want their money back urgently right now. So how would you liquidate so fast, how would you give them back the money? And so you have to take care of your liabilities, and that's why it's always better for a bank not to invest the majority of their assets in bonds. Just try to keep a bit on the side just in case this event like this that's happening is really contagious. It keeps spreading from bank to another bank, and it's just not ending. So, so yeah, I just wanted to give you a quick update and tell you more about it and explain to you the concept of bank capital and the two layers and what's really going on because people are getting confused. So I thought it would be beneficial for me to do a video. But thank you so much for watching. I hope you watch all my videos. You can subscribe to my channel, subscribe down below, and I would appreciate it if you can subscribe to my channel. Thank you so much for watching.